Thank you to all who are joining. We'll allow a minute for people to log into this webinar, and then we'll get started. Thank you so much for your patience. Okay, we're going to go ahead and get started. Welcome to our Sustainable Investing webinar, where you'll be learning about how best to align your finances with your values. I'm Marianne Holland. I'm the Senior Development Director for the Hoosier Environmental Council, and I want to thank you all for joining us today. I've asked HEC's Executive Director, Sam Carpenter, to kick things off today with a little bit about our organization for those of you who may not be familiar with us. So take it away, Sam.
Wonderful. Thank you, Marianne. Thank you, everybody, for joining today and sharing your time with us. And for Chris, for his presentation today, Marianne will introduce him further. But I'm Sam Carpenter. I'm Executive Director with Hoosier Environmental Council. I have been with the organization for about 3 years. Hoosier Environmental Council, for those that this might be a little new to you, we have a vision for Indiana where all residents have abundant access to clean water, natural lands, pure air, and affordable clean energy. And we see sustainability and economic growth, community prosperity, those things going hand in hand. We have a 43-year history in our state, and our work kind of breaks into four main buckets. One is education, doing webinars like the webinar that we're doing today. We also do advocacy, where we try to provide people with the tools and resources they need to be effective advocates for environmental progress in our state. We focus on policy and best practices, how to implement best practices in business and agriculture and development, as well as policy primarily at the state level, with the state legislature and also some at the local and federal level. And last, on accountability. And accountability is when those current rules and regulations aren't being followed, then sometimes Hoosier Environmental Council will get involved with a legal challenge. So it's an exciting time for our organization. We just are implementing a new strategic plan. As part of that, we're developing longer term goals to proactively push Indiana forward on progress on some of our environmental challenges, areas of energy and climate, water quality, environmental justice, sustainable agriculture, land preservation, environmental health. These are all areas of focus. Just briefly on a day-to-day basis, some of the key things that we're focused on right now, data centers and the strains that they're putting in our environment, our utility bills, our water quality, and on communities, citing for clean energy and renewables. We are growing in our energy demands, and how can we also grow our clean energy? Statewide water planning and protecting that precious resource. So we do this through building, working in collaboration with partners where we have aligned goals. So that's just for those of you that might be new to HEC, that's a little bit of a background for you. But thanks so much for joining us today. And Marianne, I'll hand it back to you.
Thank you, Sam, for that overview of HEC. Next up is our speaker for today, but before I introduce him, I wanted to let you know that the presentation will be followed by a question and answer session. I'd encourage you to please drop your questions into the chat at any time during the presentation. A special shout out to two individuals who will be helping us answer your questions today. Lark Valenti from HEC, who will be answering questions that you may have about the Hoosier Environmental Council, and Zena Kumok from C.H. Douglas and Gray, who will be assisting with financial question responses. Okay, it's time to introduce our speaker, Chris Douglas. Chris is the founder and principal of C.H. Douglas and Gray Wealth Management, where he leads a team providing personalized, values-driven financial guidance. An eighth-generation Hoosier and Princeton and Wharton educated Air Force veteran, Chris has been named a five-star wealth manager every year since 2008. He's also a longstanding civic leader, founding the Indy Rainbow Chamber of Commerce, helping advance Indiana's first LGBTQ non-discrimination policies, and earning numerous community service and business awards. Sorry about that. Chris continues to serve on multiple finance and advisory boards across Indiana. I'd like to add that C.H. Douglas and Gray Wealth Management has been a longstanding member of our HEC Green Business program, which seeks to connect environmentally responsible businesses with the people who want their spending decisions to align with their environmental values. So, all of you. So with that, Chris, I'm going to turn it over to you.
Great. Thank you. Well, thank you everyone for attending, and let me see if I can, hopefully this all works. Hopefully you now see a slide. It's a delight to discuss this matter, and when the Hoosier Environmental Council asked us to share some information, I was delighted because I think this is a fascinating area. And so what I thought we would do is we've had our welcome and introduction, and then since everybody's joining, we have lots of different levels of understanding. We'll have some real basics in terms of investing, and then what sustainable investing means and what the different paths are to it, and some of the complications of the arena, and how you can have your investments make a difference, and how to get started in Q&A. So first of all, some investing basics. We have people of immense sophistication and experience that come into our office, and but they have their own field. So just the most basic question, of course, is what is the difference between stocks and bonds? And many of you will know this immediately, and others I think will be new to, but as a general rule, stocks, you are an owner of a company. And if the company does well, you'll do well. And if the company does poorly, you may do poorly. It's called a share of stock because you are having a share of a company. And in general, overall, companies tend to make money, and so investors in stocks tend to make money, but it can be affected over time. It can be a bit volatile as a result of the comings and goings of the economy, of competition, and of industries. And so the ride can be rocky. Bonds, you are lending money. You may be lending money to the government, a government bond, or you may be lending to a company, a corporate bond, and they agree to pay you an interest rate. I'm simplifying this greatly, but they agree to pay you an interest rate. And let's say you're lending money to Microsoft, and their bond is paying 4%. If they do really, really well, they pay you 4%. If they do really poorly, they pay you 4%, unless they do so poorly, they default. So in general, then, stocks, very volatile, tend to make more money, riskier. Bonds, more stable, tend to make less money. And so a study was done on this, by the way, by a professor of mine at Wharton, Jeremy Siegel. He's still around. The study's been around for 30 years and updated. But just to give you a sense of the importance, it's that if you put $1, he did a study back to 1801. If you put $1 into a can and buried it in the backyard and adjusted for inflation, today that dollar would be worth about 4 cents. If you put it into gold, 200 years later, that dollar worth about $4. So gold, a good hedge against inflation. not a great return over inflation. If you put it into bonds, that dollar today, 200 years later, worth about $2,000. So that's starting to sound like real money. But when you put it into stocks, 200 years later, the latest figure that I saw was that stocks would that dollar worth about 2.3 million. So one of these things is not like the other. The stocks have, and his big epiphany was that over the long term, the slope of this line is about 6.5%, that stocks have tended to make about 6.5% over the rate of inflation. And so with time, that adds up. So so that is why so much of the emphasis of investors is on stocks. It's a bonds stability, a reasonable return, stocks a better return and better protection against inflation over the long term. And so how can you buy these things? Well, you can buy stocks and bonds individually through a broker, or you can about 100 years ago, it became common to put your money in with other investors into a mutual fund where there'd be a manager that would be buying them together. And initially, it was an active manager that would be selecting stocks for that fund and for all the investors within the fund, or selecting bonds. And but with time, the idea was that markets had become so efficient that it was hard for an active manager to get much advantage over the markets. And so you could just buy a fund that just tracks an index of all of the stocks in the market or of a given part of the market. And so that, for instance, the fund company that became famous for that was Vanguard. And then more recently, uh, 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 rather than having an active manager selecting and buying and selling, then the whole fund gets grouped into a basket, and the whole thing can be traded through the day in an exchange traded fund. So I mention these things because this is getting the vocabulary down as we consider about how you get invested in a way that is aligned with your values. And then finally, where would you invest? Well, you can do them you can invest in individual brokerage accounts or in tax sheltered accounts, whether individual retirement accounts or through your employer workplace options, 401ks, 403bs, et cetera. So with that in mind, then, sustainable investing, what is this? Of course, there can be lots of different definitions, but broadly speaking, when we talk about sustainable investing, we're talking about aligning investments with environmental, social, or ethical concerns, rather than focusing only on financial return. And another word for this can be values-driven investment. And the complication is, of course, is that values can mean different things to different people. Here you have, for instance, the Indy Rainbow Chamber of Commerce there meeting in front of our office, an LGBT group. Well, there are plenty that for whom the values of an LGBT group would conflict with theirs. So you've got to think about what are the values that you're referring to. And then in the world of investment, you can have also different sort of values-driven investment options. So whether broadly sort of environmental, social, and governance, and there are fund companies that have reputations in that, or there are faith-based investment options, or you even have and they can conflict in terms of what their values are. Or even within faith-based space, you can have investment options that are associated with different faiths, and those can conflict with each other. Or you can have issues-driven investments, and so you can have gun-free investments, and then you can have investments that emphasize guns. And there is, in fact, even such a thing as a MAGA ETF containing the values of MAGA. And so the bottom line is, it isn't just about ESG, it's about whose vision of ESG, with what values. And we have to be clear about our values when we're selecting investments. And so then even once you're clear on your values, there are multiple different or intersecting paths to getting there. And so I wanted to go through a few of those paths. First of all, you've got sort of the original concept, which was ESG integration, built on addressing risks. And they could be environmental risks in terms of climate or what have you, or social risks revolving around labor practices, or governance risks. How is a investment or how is a company run? And the idea originally was, for many investors, was the idea that if you paid attention to these things, these kinds of companies would be better run and ultimately deliver a better return. So there was an idea that integrating ESG into investment thinking would enhance return. It's important to know that some of these things can differ. For instance, I think of a fund company that I always had a very, very high opinion of for its ethical treatment of its investors. And at one point, I was meeting with one of the fund managers, and I noted that they had a significant amount of investment in tobacco. And when I sort of said, "Look, do you have any concerns about this? It seems there's some ethical issues with investing in tobacco." And it was like I was talking a foreign language to that fund manager. Yes, incredibly ethical in their treatment of investors, but differing in terms of our concepts of ethics as to what kinds of businesses we should be promoting. And so these things can sometimes be well aligned with each other, and sometimes they can be in conflict with each other. And so the next sort of then, as sort of the field moved on along and developed, um, a common technique then became filtering. And that meant where, well, it's not so much what you're interested in investing in because you think it's going to deliver a better return. We'll get back to that topic in a moment. But it's more, there are things I don't want to invest in. And so traditionally in ESG investment options and filtering, you'd have companies that would filter out fossil fuels and tobacco and weapons, and or companies with poor labor environmental records. And um, uh, that we're going to get that in a way very good for the conscience, but we're going to get in a moment into why that has become problematic over the last, let's say, 10 to 20 years. But you still see a lot of filtering going on where you're encouraged to invest in a particular fund. And what is the fund's strengths? It has filtered out the things that you don't want to be invested in as a matter of conscience. Another then realm within this, so you've got investing for enhanced return, you've got it's getting rid of those things that are problematic for the conscience, or then you've got never mind return, or perhaps in addition to return and filtering, it's I want to have an impact on the world through my investment in promoting certain kinds of actions. And so clean water funds are good examples, and that you're investing in companies that are working on the solutions to the world's problems. And we'll get back to that in a moment. But then also finally, you've got what you've called engagement investment. And that is because in the case of a shareholder, you are part owner of a firm, of a company that gives you some rights. And you're using your ownership of shares to influence companies. And so all of these have their logic to them. But I think there is each of them has a little bit of a hitch, we'll say. And so what's real and what isn't? It's really, you do want to pause and think carefully and critically before selecting your course of action in this realm. And it can be complicated. And not only can it be complicated, it is evolving. And let's say 10 years ago, I might have said it is evolving and progressing. Now I will just say it's evolving. In some ways it's evolving, in some ways it's not progressing, and in some ways it's regressing. And so I just wanted to touch on some of the aspects that we'll call them hitches. First of all, uh, if you're speaking about ESG investment as a direction for enhanced return, that idea is noble, but the data isn't really supporting it. It's not there's not really increased return coming out of the ESG investment. And now sometimes there can be indirectly. So, for instance, for a long time, if you spoke about ESG investment options, whether it was filtering or other forms, those investment options tended to be focused on companies that had clean records. Well, companies that have clean records tend to be newer companies. And so old companies, certainly old utilities or old manufacturers or what have you, well, it's hard to find a company that is of great age that doesn't have a mixed record. And so in the ESG category, then in mutual funds, you tended to have new companies. And well, what did those new companies tend to be in our economy? Well, tech companies. And so in some periods, then, when tech really took off, ESG really sailed right along with it, not weighed down by old industry companies, and instead riding the tech wave. And so that was great, beneficial. But we've had this changing world where in some years, for instance, interest rates and inflation skyrocketed, and this affects value, the way companies are valued. I won't get into that, but they hit tech companies particularly hard. I think it was 2022 that tech companies got particularly hit hard. And then in this world, what companies, unfortunately, are doing particularly well? Fossil fuel companies. And as a result of the events in the Middle East, and weapons manufacturers, for instance. And so we're seeing growth in those areas, and therefore growth in the overall markets that can, to some degree, leave some of the ESG investments behind on a short-term basis. And then, but really, over time, the dynamics are such that ESG investment may not produce outperformance, but it also, I really don't think, produces underperformance either, because these forces come and go over time. And so our observation is that ESG portfolios have tended to track the markets over time pretty well, sometimes a little outperformance, sometimes a little underperformance. But I wouldn't engage in the field with the idea that it's going to produce outperformance. I also wouldn't shy away from it with the idea that it's going to produce underperformance. And really, that's because of the way securities are priced. And you could just say that the markets operate to some degree with a ruthless efficiency, where they're not looking at ethics one way or the other, either positively or negatively, in terms of the pricing of securities. And therefore, let's say even when you think that some particular area is going to do especially well as a result of its corporate dynamics or governance, those expectations are usually already priced in efficiently in a market into the stock. And so there's not necessarily an advantage from a return perspective to buying it, nor is there necessarily a disadvantage from a return perspective to buying it. So now filtering, though, I think filtering has become a little bit more problematic, actually. And filtering enables you to say, well, I'm not investing in tobacco, I'm not investing in firearms or in polluters or what have you, and that's great. But are you really having an impact? And in some ways, are you even perhaps even having an impact that is adverse to what you want to be having? And the reason relates to the transformation of the economy. Back in the 90s, we had over 7,000 publicly traded stocks, and that was a product of decades of public policy of producing a rollout of our private wealth into the general economy and into public ownership. and uh, publicly held companies really very uh, much regulated, responsible to shareholders, but also to regulation and with a great deal of transparency. And what's now happened is we have less than 4,000 publicly traded stocks because of mergers and acquisitions. And then we have this really increasing disparity between the top of the economy and the bottom of the economy. And the result has been that we have a huge amount of cash and wealth up at the top of the economy. And whereas, let's say 20 or 30 years ago, if a business concept wanted to raise capital, it would go to the public markets and sell its stock out, and in order to get buyers of its stock, in order to get funded. Well, that's not really happening anymore. What's really happening instead is we've been going through a great period of our publicly traded market getting absorbed back into private hands, and that means that less transparency. That means greater concentration of economic power. That means less responsibility to the public. And just recognize that the way that companies are achieving this is ultimately through share buybacks, which is to say, all this money is floating around in private hands. They don't really need to go to the public markets to retail investors to obtain money. And so the bottom line is they don't need your money, and they don't want your money. They don't want our money. It's they don't want us. Why? Because as shareholders, as responsible shareholders, we can be problems. We can be introducing proxies. We can be going to shareholder meetings and demanding actions on things. And so really, they would rather have money invested in them that is complacent, that is compliant, that isn't troubling them. And so when we filter out companies, we're really giving up a significant leverage over those companies. And there are still certainly worthy aspects of filtering, and that is uh, uh, there are some companies that are perhaps in businesses that are perhaps beyond redemption or using their profits in ways that are highly problematic. And so that can be, if you are doing business with a company and you're contributing to their profits, and those profits are being used in a problematic way, um, well, I think that's a good argument for taking your business elsewhere. But as an investor, when you walk away, that is in the present economy when companies are not selling shares out, but instead buying shares back. In some instances, they'd like nothing more than for you to sell their shares back to them. And then regarding impact investing, I think this is worthy. Sometimes it's worthy, most worthy maybe in a smaller business environment where a fund is being raised, for instance, for micro loans or what have you. But just recognize that when you're sitting there saying, "Well, we're going to invest. I'm going to buy shares. I'm going to invest in a mutual fund that is." Investing in the world and impact in the things that I want to see happen. The reality is that what you're doing is you're buying shares really where that money isn't really necessarily going into the investment anymore. It's just being traded. You're buying it from somebody else who's selling, and so yes, you can have the sense of satisfaction of knowing that you're invested in important areas, but recognize that your dollars are not necessarily having the impact that you think they're having. They just may have gone to another investor that is sold away. And so I think impact investing is not a problem, but it may not also be having the impact that you may hope that it is having. And then so finally then is engaging in what I'd call engagement investing. And this, I think, ironically, we'll say has become, I think it's a very, perhaps the most effective means of investing in a conscience-driven way. And that is through uh, uh, investment vehicles where you're pooled with other investors into becoming where that fund option becomes a significant investor in companies, and they are able to use their investment weight in order to influence the management of the company as important shareholders in that company. And I think that there's some, here as we talk about the hitches, it's this too is a evolving field. And so, for instance, KLD is a great socially responsible index fund. It operates on a filter. Uh, uh, but for the reasons that we've discussed, that isn't necessarily having the social impact that we may think it is having. It may help our conscience, but is it improving the world in any way? Not necessarily. And so, in some ways, ironically, BlackRock, for instance, a few years ago, and over a period of time, became much more socially conscious as a investment firm than one might think, such that Larry Fink, the head of BlackRock, was BlackRock and Vanguard being huge holders of our corporate assets in this country. Well, BlackRock took seriously, and Larry Fink took seriously the responsibility of that. And he started issuing a yearly letter that started paying attention, saying, we as shareholders in your company expect you to pay attention to environmental concerns. We expect you to pay attention to the development of labor and the well-being of labor. And really, these letters and then the company's pressure and its use of proxy votes became so impactful that there was pushback. And very controversial in the investment arena. And at the same time, then compare that to Vanguard, which is a great company, very, very responsible to its investors. It is mutually held by its investors. Sterling reputation. But there was a period of time when Vanguard's point of view was we are a passive index company and we're just going to hold these shares and we have no responsibility. It is contrary even to our philosophy to use our share ownership to influence businesses. So the irony then was that of these three, the KLD Socially Responsible Index Fund, BlackRock, and Vanguard, the one that maybe I think was having the most positive social impact, arguably, was BlackRock. And um, Vanguard eventually came around, and it has become more responsible. But then when I say these things are changing because of the pushback, and I'll just say from my experience that we were seeing the pushback in the investment industry to BlackRock, and a BlackRock representative would come by our office annually. And a couple of years ago, he walked in the door, and I said, "I just want to tell you how pleased we are with the pressure that Larry Fink is exerting." And he expressed this immense wave of relief. He'd been beaten about the head and shoulders so much by financial firms that to have a financial firm say we really like what you're doing was a wave of relief for him. At the same time, now we've had politically uh, that these socially responsible approaches come under fire, and so that um, here in Indiana, I think the Attorney General has gone after, and others have gone after companies that and funding options that put too much of an emphasis on uh, ESG investing. Or you've got in other places, you've got some employee groups that have taken up arms against their companies for having socially responsible investment and putting in the idea that that was subverting return, which for the reasons I've discussed, I don't think it does. But what we're seeing then is companies that were highly engaged on these topics starting to back off from them. And so that sort of takes us back, I think, to those investment options that have been around a very long time and are not so much subject to those pressures because they're so well anchored. And so I just, to mention some of those companies out there, and I'd say with disclaimer, I'm not recommending any of these one way or the other, but those that I think have that their reputations for their social conscience and their approaches are well deserved. Just to name a few, Calvert has been around a very long time, and it uses its proxy voting in corporate advocacy, et cetera. So it has that sort of engagement. But it can be engaged both in filtering and it can be engaged in promoting companies that are having a positive impact in various areas. But then they are also using their share ownership to pressure companies. And by the way, even a tobacco, not that Calvert would invest in tobacco, but you could say, well, how could you pressure a tobacco company, for instance? Well, a shareholder initiative could be going after a tobacco company's marketing to youth. I mean, or putting out flavored tobacco or what have you. So even companies that might be inconsistent with our conscience, there may even be ways in which they can be pressured to behave better. The same might be said with regard to gun manufacturers, for heaven's sake. So even these things that might be filtered out, well, maybe there are other ways of engaging with them that can get some positive social impact. Another, Parnassus Investments, always strong on workplace practices and governments. They've been around a long time. And Domini, environmental sustainability and human rights, and they have index funds. By the way, the disadvantage of actively managed funds over index funds is they do tend to have higher expenses associated with them. And we very much favor low expenses. And so that is a trade-off when you're talking about active management that may be involved in selecting and engaging with corporations. And then Green Century Funds is focused on fossil fuel-free investment. And then you've got Impacts, which is sort of resource efficiency. All of these are very solidly committed ethical companies. One complication, I think, though, for instance, is Calvert was once owned by an organization called the Acacia, which and now it is owned, I understand, by Morgan Stanley. Morgan Stanley, let's say historically in the last 20 years, has I think engaged in some questionable business practices. If you were to Google them during the tech boom, and so here you've got I think a highly ethical company that is held by one that is not as ethical, in my opinion. And then, of course, you've got BlackRock and Vanguard that have now their own ESG suites. And the point is, I think, ultimately, how do you get started in investing in these things? Well, first of all, the first thing you have to do is define your values. And as we've seen, they can conflict and I think, write them down, be very clear, rather than, let's say, going to a investment option and reading their website and having them sell their thoughts to you. I think the first thing you want to do is get very clear about what your own thoughts are, and what you support and what you don't, and then research with a critical eye, and go to the fund company websites, get their prospectuses. It sounds like a prospectus is a long, dry document, and they can be a little dry. But the fact is, those prospectuses are also legal commitments. And so you go into a prospectus and you get sometimes some very clear statements about what they do and what they don't do. And so once you have your own, what you want to see done, what you want to support, what you don't want to support, go in and look at these companies, these fund companies, and think through what they're saying, and is it getting done the things that you want to get done, and with a critical eye, mindful of some of the things that I've shared here. It can sound really, really good, but then if you just step back and say, am I really having the impact that I want to have? That can be a different question. And then how do you get access to these kinds of investments? Well, for a great many, the best place to start is with your retirement accounts. They can be in individual retirement accounts or through your employer. And maybe this is the first opportunity for some activism as a person is to say, well, if I'm not seeing what I need, I'd really like to. And it's an opportunity then to talk with HR or talk with management about providing some options that are consistent with your conscience. And then there, in order to buy these things, ultimately you have to work through a custodian or a broker dealer, and you know there are lots of them out there. You've got that sort of the discount broker dealers like Charles Schwab or Fidelity or E-Trade, and there too you might want to investigate. Well, where are these companies making their financial contributions? Are they consistent with the way that you want to be thinking? And it's interesting to note that, for example, we started with TD Ameritrade Institutional as our custodian for our clients. That got bought by Charles Schwab. Charles Schwab created a lot of pushback because of its political contributions, and an uproar took place, and Charles Schwab has now said they're not making political contributions anymore as an organization. And so speaking up, even when you're talking about what avenue you're going to get access to these things, even that is an important thing to be thinking about. And then make your investment. And then finally, I think become involved civically, because these things that you're doing, the options that are available to you and how they're regulated are all impactful. And so to be thinking through and become engaged is valuable. So that is a quick survey, we'll say, of the field of ESG investment. I actually could go on at length about any one of these topics, but I'm happy to spend a little time chatting and answering any questions that any may have.
Awesome. That was great, Chris. Thank you so much for so much interesting and informative presentation on ESG investing. And I want to say thanks to those of you who have been submitting questions in the chat. We'll get to those in just a moment. And thank you again to Lark and Zena, who have been answering some of those questions as we've been going along in Chris's presentation. Please do keep dropping your questions in the chat, and Chris and I, along with Zena and Lark, will continue answering them. So let's get started, Chris. We had a question from Mallory McCollum. Hi, Mallory. When looking at a company's financial statements, what can we look out for to ensure they're committed to sustainability and not just greenwashing?
When we're speaking about the company's financial statements, you mean through, for instance, their corporate reports? That's a good question, to be honest with you. Can you get the insight that you want to through the financial statements? I think you can look at the corporate reports, read those carefully. I think maybe this too is a field that is evolving. Morningstar, for instance, has developed a has developed grades for sustainability where you have analysts that are looking more deeply into corporations' practices and grading them. And I think, look, I took a class, in business school on forensic accounting, and that was 30 or 40 years ago, and I just don't do it anymore. And it was complicated at the time. I think that
Fascinating.
if you're operating forensically, you may be able to pull some things out of those financial statements, but I'm not sure that you as an individual investor will find those things. I think that independent parties that are examining the companies more broadly and holistically, not just through their financial statements, but through observations and interviews of management might be the better approach, getting some of those grades. And for instance, Morningstar grades companies individually.
So Chris, of course, one option for some people is to be able to you know, get in partnership with an organization like a business like yours and be able to talk through exactly what they're looking for. For Since most people who are joining our webinar today are extremely interested, especially in the E in ESG, the environmental aspect. Are there, I mean, are there tools out there that would at least evaluate from that one lens as opposed to trying to take on all your values at once? So for example, are there industry writers that you can look to, or aggregate sources of information that go and evaluate from the strictly the environmental aspect what kinds of to help kind of guide individuals a little bit on
Um,
who's rising to the top?
let me let me commit to coming back with an answer to that.
Oh yeah, you bet. Actually, Chris,
The,
we're keeping all of our questions. So if something doesn't get got, if one of your questions doesn't get answered today, folks, we'll be sending a follow-up email. So that information will be in there.
Yes, yes, I will report back on that. We've tended ourselves to value um, the fund companies that are engaged ethically, uh, and my observation is they are good faith. That those that I named are good faith companies, and so so we sort of rely on them to do the engagement that we hope to see. And but so we're not really doing ourselves individual company by company, and so we haven't really even developed that muscle strength. Uh, uh, but I can come back with an answer to that question and perhaps guide you to some writers.
Great. Excellent. Let's see here. This is a somewhat related question that I want to ask. It's actually from Molly Moon. Which credit card companies are the most ethical or green to use?
We're not an expert on that either. Um, uh, Let put that on the list of. I must say this is a field that is constantly evolving, and these are great questions, and I can have an informed opinion, but I don't have one at the moment, and I'm happy to develop one. So
Oh, that's great. That's great. Thank you. I Another question is a, a clarification or a term question that I wanted to ask you in terms of discerning the difference between different types of funds. What is an EFT and how does it look different from an ESG mutual fund?
so an it's uh, ETF, not an EFT, an ETF. Uh, it is yes, without getting too much into the weeds. ETFs were an innovation that came around, about 30 years ago, 20, they really began to spread about 25 years ago. And there's a vast advantage to, in general, using index funds for investment, and that is where you're not actually using an active manager. From a pure return perspective, you're relying on the efficiency of the market. And but all mutual funds, when you buy or sell a mutual fund, it trades at the end of the day. So let's suppose that you buy a fund in the morning, and it goes and but in fact what you're doing is you're buying for it, even though you placed your order in the morning, it comes up, the prices you get are the end of day prices. So if let's you have a big, gosh, one of these weeks we had, heavens to Betsy, we had some parts of the markets that were up over 5%. And if you had bought the fund in the morning, uh, uh, it was 5% more expensive by the end of the day, but that 5% more expensive is what you paid. Well, an exchange traded fund takes that basket, and rather than a fund manager trading the individual stocks at the end of the day, buying that uh, whole basket gets traded at the moment you place the trade. So it's called an exchange traded fund, and so you get the prices at the moment you place the trade. And for long-term investors, it's kind of immaterial, but they're very tax efficient. So there are all technical aspects of ETFs that are very advantageous. But mutual funds are very, very similar, and it's sort of another way of just buying a basket of securities, a basket of stocks, or a basket of bonds. Did that answer the question?
Yeah, it did for me. And we just had a comment, I think a question from Jamie Valentine. I have found that with the amount of money I have to invest, not a lot, that a lot of investors, it just jumped up a little bit. Hold on just a second. This is why I do not love having to monitor the let's see here. A lot of investors that will work with me or have said I do not have the amount of investment to gain money and be as picky with my values and who I would invest in. Is this accurate?
I think what you can do is uh, these days, investing individually is pretty easy. I mean, you just go online and open an account with an online broker, Charles Schwab or E*TRADE, and the world is your oyster. And I think uh, ETFs are wonderful vehicles, and settle upon your values. The world of ETFs and mutual funds that are available to you is extensive, and you can uh, buy those things yourself uh, on an online account, and um, uh, so your options are not limited, it seems to me. I think you can get done what you want to get done.
Great. Here's another question from the Q&A. It keeps like it's moving a little fast. Sorry. um, I let's see here.
I see a
Yeah.
question.
Okay.
Do you have other suggestions for individual online trading platforms?
Perfect. Thank you.
Yeah. Uh, we haven't, we are a registered investment advisor and fiduciary, and we have, uh, and so we work with major custodians. And so we are, so we're not so much involved in the whole universe of what online trading platforms exist out there, except to know that there are many that are perfectly reputable and perfectly solid. And so, whether it's Scottrade or E*TRADE or the or Schwab or Vanguard, those are all good places for a small investor to get started. But I'd also say this: I want to caution. It's don't get in my opinion, don't get involved in individual stock trading. And humbly, I went to Wharton, which is among the leading finance schools in the world. And I remember a professor saying 2/3 of actively managed mutual funds underperform the market, and of the 1/3 that outperform, their history in outperforming is no statistical prediction of their future in outperforming. He said it's very disappointing. And that really becomes an argument for just buying an index, getting the exposure you need, and even the most professional of fund managers buying and selling individual stocks have a miserable record of outperforming the markets. And so that's the argument for getting a low-cost index fund. The world of and so pay attention to the expenses, and the prospectuses tell you very clearly what the expenses are. But the greatest mistake that I think people can make, starting investors, is to get involved with individual stock trading. One of my mottos is wisdom is the accumulation of painful experience. And my observation is that there's a lot of painful experience out there that people think they know what they're doing until they discover in a dramatic way that they don't.
All right, let's see here. We've got lots of questions coming, more than we're going to be able to keep up with. So I just want to remind people again that we will be answering all of the questions in a follow-up email that we don't get to. So let's see here. I've got a question. I'd like to move my investments to funds that align with my values. Would you recommend selling my shares in the current funds that don't align with my values and putting that money onto ones that do that, leave it where I have and move any new investments, or another strategy? I know you're unaware of what I have and can't necessarily give advice on this, but any thoughts you have would be appreciated.
No, this is what we'll say. I think the answer is in one respect very clear, and that is if your funds are in a retirement account, in an IRA, or a traditional IRA, or a Roth, there is no they have capital gains accumulated, but there are no tax consequences. If you sell them, there are no tax consequences. So you can, let's say you're in an IRA where the world is your oyster. It may be at Schwab or where have you. Uh, uh, you can sell what you have, no tax consequences, and turn around and buy what you want. Or if you're in a locked-in environment that isn't giving you the options you need, you can open an individual retirement. Let's say you've got it in an old employer. Let's say you've got your accounts in an old employer and a 401k. Well, you open an IRA, an individual retirement account, you transfer your assets from your 401k, go to your employer and say, I want to transfer, and they're perfectly experienced in doing this, and I want to roll it over into my IRA, and there's no tax consequences from the 401k to the IRA, no tax consequences. And so a lump sum arrives in your IRA and you can go ahead and buy what you want. So within the retirement account environment, I would encourage you, sure, there's no reason why you shouldn't sell what you've got in order to buy what you want, provided you maintain the broad diversification and risk. This one could have a whole different seminar on how you allocate to control risk. So you want to be diversified and risk adjusted. Provided you've done that, no problem. The issue is if you're in a taxable account where you have accumulated capital gains and you want to move from here to there, and then you would have to sell and pay the taxes on those capital gains in order to buy what you want, and that would be we would tend to think that's disadvantageous because part of the investment life is being as tax efficient as you can be and not paying taxes that you don't have to until you want to or need to. And so I would tend to recommend against selling in a taxable and paying taxes in order to buy something else. At the same time, if you're in it, let's say you're in an actively managed fund in a taxable account, that fund may have a significant amount of turnover and it may be paying taxes on a regular basis, and your accumulated gains may not actually be that much. So it depends, is the bottom line. But hopefully that's provided some guidance.
Yeah, we had so much great information and so many great questions from everybody. Feel free to please still drop them in the minute that remains. We won't be able to answer them today, but we will respond with a follow-up email to the webinar. with that information and all your unanswered questions, hopefully answered. So I want to say thank you to everybody for joining us. I've just been watching the participants list, and almost no one left from the beginning. So like it was obviously very engaging and interesting. I always measure that. So I want to let you know also that a recording of the webinar will be made available on HEC's YouTube account. You can watch it again or share it there. And also, we talked about the unanswered questions. And then finally, I want to say that this webinar was brought to you today as a part of the Hoosier Environmental Council's Earth Month celebrations and community building initiatives. If you learned something today, if you're inspired by our work, or you just want to invest a few of your own dollars in policy and program work improved at aiming Indiana's environment, please consider making a gift to support the Hoosier Environmental Council at hecweb.org/donate. One bonus is that all individual gifts this month are actually being doubled up to $25,000 total, thanks to our board vice chair, Ellen Rosenthal, and the Netherly Fund. Thank you again, everyone, for joining us, and have a great weekend.
Thank you all.